2024 turned out to be a much better year for SoFi stock investors than initially expected. Of course, the stock price is still down 1.5% year to date in 2024, but that's after the stock was down over 30% halfway through the year. The second half of the year is when the stock price regained momentum and has surged higher. But 2024 is almost over. What about 2025? Should investors buy SoFi stock for 2025 or before 2025 starts? That's the question I'm going to answer in this video, looking at some of the company's most important financial metrics and doing several valuation assumption estimates to determine if long-term investors should buy SoFi stock here in 2024.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So I talked about the price movement in 2024, and you can see this on the chart here. A big drawdown and then a big recovery. You might be asking, why did this happen? What were the factors? Primarily, it was the lending business. If you remember, around this time last year, SoFi management told investors that it was going to pull back on lending. It wasn't going to lend as much because it was concerned about consumers in the United States. It was concerned that the slower job growth, rising inflation was going to pressure consumers and we could enter a recession in 2024. That's how management felt at the end of last year. And that feeling persisted for maybe the first 3 to 6 months in 2024. We got the similar kind of commentary from SoFi's management team in the first part of the year. And then something turned, and towards the middle of the year, SoFi management became more optimistic. It said, you know what? It looks like the US consumer is much stronger than we thought. Their job gains have persisted, even though the economy slowed down a little bit. Employers didn't make huge layoffs. And so because they felt more comfortable about the position of the US consumer, they said, we can lend a little bit more. We're not so fearful about a recession anymore. And that led to increasing lending activity. And now the company thinks that in 2024, when it's all said and done, they'll actually grow the lending business this year. When, remember, coming into the year, they were forecasting a decline of about 5 to 8% in the lending business. And that's a big part of its business still, even though it wants to transition to becoming more services-based and less lending-based. It's still a big part of its business. So that's contributing to this big turnaround for SoFi Technologies. Looking back longer term, its revenue growth has been excellent. From 2021 to the most recent trailing 12 months, revenue has almost quadrupled from 600 million to 2.5 billion on a trailing 12-month basis. And what's driving this is an attractive opportunity it offers, an attractive customer value proposition it offers to people that are signing up. Since SoFi is an online-only bank, a digital bank, it doesn't have physical branches, and so it doesn't need to pay for the upkeep and the maintenance and the capital to maintain that kind of presence physically. And so it devoted more resources to attracting customers. One of the resources it was using is an attractive percentage yield on your savings accounts. If you have direct deposit with SoFi, you get industry leading returns on your balances in your bank account. And so that attracted a lot of people from brick and mortar banks that usually give you somewhere around 0% if you have your money in the account. And on top of that, they charge you a monthly fee. I know one of my bank accounts is very unattractive. It has a 0% yield on the money I have in there. And they also charge me a monthly fee if I don't meet certain requirements in the month, which happens frequently. And I would change the bank, but it's such a hassle to change the direct deposit information and all of the online bill pay and all of that, right? So if I get a chance one day, I will switch out of that bank and into something like SoFi that offers better terms. It's more attractive, because the physical branches are not very helpful, especially not for me. Maybe they are for some individuals, but the physical branches of the banks that I bank with have not been helpful at all. And so this business model is turning to be pretty lucrative for SoFi. You can see their improvement in earnings per share on a trailing 12-month basis. They became profitable on the bottom line only recently, and they forecast that earnings per share are only going to increase from here. So management is optimistic about its earnings per share prospects, and you can see evidence of significant improvement in this regard. Return on equity is an important metric when you're evaluating banks, and SoFi has done a great job on generating profits from the equity. 3.68%. The number is not very high, and if it were to stay here, it wouldn't be an attractive investment. But what is impressive is the trend line improvement from negative 12% there in 2022 all the way up to now 3.7% and moving higher at an reasonable pace here if you're an investor following the company. I suspect this will continue, especially as the company transitions to more services based revenue. Those are more lucrative and more profitable with lower capital requirements. And so that could lead to an even accelerating rate of improvement in this metric. So now let's get into some of the valuation metrics. And I'm going to look at three different valuation metrics here. First, I'm going to look at the forward price to earnings ratio, which at a forward PE of 67, the valuation is looking a little bit rich if you're evaluating the business based on this valuation metric alone. And you can see the big run up since mid 2024 in July when the stock price has run up. The earnings per share multiple has also increased. Another way I evaluate a business valuation is by doing a discounted cash flow analysis. And I did this one for SoFi stock around October 7th, but it's still very relevant today. The financial metrics and the estimates and assumptions I used to create this model have not changed all that much. So my intrinsic value per share calculation for SoFi stock came out to be $21.38. That's how much I feel the shares are worth today. And the current market price is $16.13. So there's roughly 33% upside in SoFi shares according to my discounted cash flow valuation analysis. And finally, I also did a estimate of where I think SoFi stock price could end up by the end of 2025. And I used the earnings per share estimates for 2026 combined with the forward PE multiple, looking at various different scenarios of the forward PE multiple to come up with the 2025 price target. And I found it to be about $21.50 at the midpoint. So evaluating SoFi on those three metrics leads me to the conclusion that the stock price is undervalued based on all three comprehensively valuation metrics. And so to answer the question, do I think SoFi stock is a buy for 2025 or a buy before 2025 starts? The answer is yes. Yes, I do think that it's a buy. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.